What if I tell you that someone did the research and found out that there is a formula that would have allowed you to achieve a 33% annual return in your portfolio? How much would you pay for that formula? Well, I think you can buy it for $20 last time I checked. If you are interested, you landed in the right channel, because today we are going to review the little book that beats the market by Joel Greenblatt, which offers powerful insight that helps you to navigate the market and make informed investment decisions. So let's get started. One of the key themes in the book is the importance of having a long-term horizon. The author emphasizes that in the application of the formula, investors usually start to see results between 3 to 5 years. Patience is a key ingredient when dealing with financial markets because in the short term, they tend to be quite erratic. By sticking to the formula and avoiding the temptation to sell too quickly, investors can benefit tremendously from the compounding.
The reason people don't outperform the market, there are behavioral problems, there are agency problems, but it's not because we're not getting those opportunities.
The second takeaway is to understand the business you are invested in. Greenblatt emphasizes that you should invest only in businesses that you can explain in one sentence. This is crucial because if you can't understand where you have placed your money, then it is very difficult that you can understand the future prospect and the potential risk the business is exposed to.
If you took a look at the market, I can look at where the S&P is trading. I can look where Apple's trading. A few months ago, it's still very cheap, but a few months ago it was trading at less than half of the valuation of the S&P. I'd say it's probably better than average, and I'm getting it at half price. I don't know if that's right, but I have a large margin of safety. I own hundreds of what I say is what we do now is, I don't know the answer to your question. It's gray. I don't know if Apple's going to work, but I don't own just Apple. I own a bucket of Apples. I own a bucket of companies with metrics like that, trading really cheap, with deploys capital well, with nice potential prospects. And so I don't know if Apple's going to work. I know my bucket of apples is going to work.
Moving on, let's discuss the importance of diversification. While the magic formula can help you in finding the winning stocks, it does not guarantee that every pick is going to be a winner. Therefore, diversification becomes paramount in managing the risk of your portfolio. By spreading the investments across sectors and stocks, you minimize the likelihood that the poor performance of one single stock is gonna crash the overall performance of your portfolio. The book makes a clear distinction between investing and speculation. So investing is about buying shares of businesses that trade at discount compared to their intrinsic value based on thorough analysis and understanding. While on the contrary, speculation is more about gambling on stock price movement, hoping that in the future someone might pay a higher price than the one that was paid originally.
Stocks are not pieces of paper that bounce up and down and you put complicated ratios on, like Sharpe ratios or Sortino ratios. Stocks are ownership shares of businesses that you are valuing, and if so inclined, try to buy at a discount.
Greenblatt encourages disciplined investing based on value rather than speculation. And finally, let's talk about the magic formula. Greenblatt introduces us to a simple yet powerful strategy that involves buying high-quality companies that have the potential to continuously grow their earnings, but that are trading at a price below their intrinsic value. The magic formula has only two main factors: the return on invested capital and the earning yield. Greenblatt argues that by consistently applying the formula, investors can buy above-average businesses at a below-average price. Also, the author provides an updated ranking of companies based on the formula, so you don't even have to make the effort to compute it yourself. I'll put the link in the description below. And that summarizes our review of The Little Book That Beats the Market by Joel Greenblatt. Remember, investing is not about becoming rich quickly, but rather about making wise and patient decisions to grow your capital over time. I really do hope that this book helps you in your investing journey. If you liked the video, please don't forget to give it a thumbs up, share with your friends, and if not done yet, subscribe to the Stoic Investor channel. Cheers and see you in the next video.